Hello and welcome to another episode of the Truth About Real Estate Investing Show. Still can't believe it. This is the number 81 podcast in the business category in all of iTunes. I think something broke at Apple. Probably Elon Musk's fault. Anyways, as the Warren Buffett quote goes, a rising tide floats all boats. Only when the tide goes out do you discover who's been swimming naked. Well, the rising tide, the real estate market in Ontario has been awesome and steadily gone up since the recovery of the 1989 crash. I know lots of people who've built intergenerational wealth between now and then. Many of you and your neighbors did very well simply by buying a house 5 or more years ago. Even if you bought in 2019, you are likely still positive, as long as you did something right. Please, hopefully you did something right. For those who bought several houses 5 or more years ago, they benefit multiple times. This past week, I hosted a mastermind dinner with many of our student rental investors, clients, as the timing is ideal as we enter the rental marketing season, as university students begin to look for a place in December and January for a March 1st move-in. Honestly, the truth about real estate investing is we had a crappy pandemic for student rental investors where students bailed on their leases and some of them went home. Some of the universities closed for in-person, hence there was less need for students to be local. Market rates went down for the first time I've ever known in my experience. Now the pendulum has swung hard the other way, in the other direction, in favor of the investor, the student rental landlord, as there is reduced supply of student rental homes. Demand is up slightly based on statistics, and rents are through the roof. A client of mine just texted me about an hour ago. She just signed a group of tenants at rents 30% higher than her previous tenants. She now cash flows over $3,000 per month on just one house. If you have a better investment than that, please let me know. Again, $3,000 per month, over $3,000 per month on just one house. If you can do better than that, please let me know how you do so in a repeatable, low risk form. Over dinner, we masterminded how to communicate with tenants if they're staying or going, what rents we'll be testing next week. We have an idea now what's working. We shared old war stories, of course. My old friend Ron Esteban even started a Discord group for everyone in attendance and named it Irwin's Student Rental Army, or I like acronyms, so that's Ezra for short, for all of us to stay in touch, and I'm humbled and I find it hilarious. Thank you, Ron. Appreciate the joke, everyone. Ron also spoiled my fun of being the youngest in the mastermind and attendance. So I was the second youngest in the room, and when I looked around, I felt like a proud parent looking at my clients, at a room full of my clients. They're all doing great. Some have retired, some can retire, some are working on very expensive contract rates at their choice because cash flow is great. They can't help themselves to the money. Several have already helped out their adult children buy their first property. Some of them almost all of them have more than one kid, so they've helped multiple adult children buy their first property. They all have significant they all have significant financial peace in their lives. Everyone has great investment properties that they're happy to own. Some have owned them for a decade already, and not one of them is a full-time real estate investor. Again, it's my position that real estate investing, for most people, most of the time, is best as a side hustle. And that's, from my experience, this is how real estate investing is done right. Done wrong, however, it can be done wrong. I will never fib about that. There are many ways to lose money in real estate. For example, an update on Alex Solga, who was booked to come on this show. Alex is one of the owners of the now bankrupt Clydesdale Capital Group, previously owned in partnership with Fayez Gulamani, aka Mark Smith, that they owe currently just over $8 million to creditors. Details, I've included a link to the preliminary report as filed by MMP, who are the trustees of the bankruptcy. So I don't want to get into details. If you want to get into details, go there. I don't want to get sued either. So from the advice of Alex's lawyers, he can't come on this podcast, which I completely understand. I did, however, share with Alex that I've seen this all before, and this will all happen again. I shared with him what I thought happened. So I've been attending investor meetings and networking events since 2008. I personally know folks and interviewed them on this podcast, investors with 50, 100 properties, 100 plus doors, whatever, massive portfolios built over a very short period of time. Most of these were in Alberta at the time. I'm talking about back into like 2008ish and the lead up to that time. I saw them sharing on stages how they did it, how they raised capital, how they find deals, how they find what they call deals, how they found real estate properties. Those in attendance, including myself, couldn't wrap our heads around how they did it. We thought they were gods of investing, and we were just messing around. We were not significant with our tiny portfolios. My own being in Hamilton, my clients as well, anyone else that was in the room, till the market turned, and their portfolios were underwater. Especially all those that were in Alberta, they were underwater. While everyone who invested in Ontario and BC did just fine, honestly more than fine, as long as they didn't overleverage. What saved them was that their properties were at least rented out. So at the time, most people avoided bankruptcy because, again, they focused on cash flow at least. Even though the property values were crashing down, they could at least cover their expenses. Again, this was largely Alberta, though I did know one gentleman in Hamilton who lost everything. Him and his wife had over 50 joint venture properties. They were all sold off by the banks at a discount. He lost his home, his wife, his family, his reputation. So again, from being around a long time, I understand the worst case scenario, and the worst case scenario is unacceptable to me and my family. Therefore, we have a lot less risk in our portfolio, much more slower, controlled, boring growth. So this is back in 2008 during the oil crash and combined with the financial credit crisis of the financial market melting down, stock markets melting down. Fast forward to present, a new wave of real estate education groups have popped up, local groups too. So less local ones, as in like I'm talking about Ontario. So these were not groups from BC and Alberta or the USA. There's all these new influencers, and these new networks and coaches with limited experience, and they've emerged, and a new cycle starts. A new cycle of FOMO starts, and from what I'm seeing, not everyone, but a good number of people have failed to learn from history. Hence, they are sadly doomed to repeat it. Red flags were ignored. Greed is unchecked. Private lending for the first time in just the last few years becomes extremely popular compared to the past. It's become popular compared to 5 years ago. Everyday folks private lending becomes popular among everyday folks as they're promised double-digit interest rates in exchange for just signing paper and handing money over on what I deem high-risk projects. And we've seen this before with the bankruptcy of Paramount Equity or like Fortress Financial. But still, brokers broker and lenders lend. Investors raise OPM, other people's money, because their vision and mindset of abundance overshadows the fact that managing trades, renovation projects, and construction is not easy in my experience, made much harder in this environment where labor is in shortage, wages are skyrocketing, and material shortages are ongoing. Long-term, boring cash flow investing wasn't profitable enough it generally isn't profitable or fast enough for anyone to quit their day jobs in the short term. So some scaled up in order to do fast flips and burrs, in order to, a business of real estate investing. It's not really real estate investing to me. It's really more like a business without the operational know-how. Resources were spread too thin. Properties are vacant when you're a flipper, when you're exclusively flipping, so no money is coming in to cover those mortgages. So back to Clydesdale. Their holdings, their properties were located. So again, I have a link to the attachment. A document from the trustee lays out all the properties that they own that were involved with the bankruptcy. Anyways, just looking at looking at what cities these properties are in, they're located hours apart. There's two properties in towns in Ontario I've never heard of. The towns I've never heard of. They're spread out To the west, there's Hamilton properties. To the north, it's up in as far as North Bay. To the east, yeah, Peterborough, and they even have a property in Belize, right? The owners live in London, from my understanding. So for me personally, this is way too much risk. I've never seen anyone pull off this much scale, covering this much geography in my career. Personally, I prefer boring stuff I can control within a 1 hour drive from my home. I do BRRRR and I do BRRRR investing. Because in my experience, renovating is such a pain in the bum. I don't want to sell these properties after I renovate them. I prefer to keep them, rent them out, keep them, refinance them, all sorts of good things. And I've been doing so since 2005, and same with the majority of our 500 clients since 2010. We do personally, I only do one property. At times, we've had 2 properties vacant, and that's because I only want the best general contractors working on my projects. And also, I prefer cheap financing. So almost always are we using A lender financing, and on occasion we're using B lender. So if you too would like to learn how to do boring cash flow investing, we at the iWin Real Estate team, we operate in the east and the west of the GTA, because generally that's where investors can find cash flowing, boring properties, and honestly, it's the best ROI I can find. Then let us know. Reach out to iWin at Infinity Wealth, and one of my coaches will be happy to get back to you and get on a call with you. We are always recruiting for those who want to be self-made millionaire real estate investors in a boring, repeatable, systematic way that cash flows. Nice, boring, and safe. Hopefully you agree that's the best way to get rich. On to this week's show. We have an old friend of mine, Russell Westcott, who was in town all the way from Vancouver to Toronto for the Wealth Hacker Conference. Russell has owned over 100 properties and has the battle scars and the lessons on how to invest better than he did in Edmonton, Alberta. Russell's a smart guy, and he's here to share about how his coaching clients are navigating this high interest rate environment with creative, above board financing and a couple different investment strategies for highest and best use to create more housing units and, of course, generate higher rents for the investor on properties that most investors generally don't see. I've been around for a bit. I'm pretty impressed with what Russell's clients are doing, so you want to check this out. And also, in today's interview with Russell, we talk about properties in Saskatoon, in Edmonton, in Niagara region of Ontario. So to me, this is quite a treat. I personally love to learn about real estate investing. As always, other than learning about real estate investing, it's always a treat to have the JV Jedi on the show, someone who's always thinking outside the box on how to maximize returns for his coaching clients and on their properties. I give you best-selling co-author, Russell Westcott. Hi, Russell. What's keeping you busy these days?
Erwin. First and foremost, hang on a sec. Let me move your hand over here. Let me touch you. You're real. You're like in person. Like we're talking. It's not a little computer monitor, and we're talking Zoom here. You're like a real human being, and we're in the same space at the same time. It warms my heart to see you, my friend.
Well, thanks for coming all this way out.
Yeah. I came out just for this.
I got some messages after the conference, and also people were just asking about buying the recordings for the conference, and I had some people that missed. For example, a client of mine, their nanny was sick, so no one to take care of the kids. They had to miss. Yep. They asked for the recording. Like, you're my client, of course I'm going to take care of you. But I was thinking, could you imagine, like, for example, like Jesse Itzler's presentation? Yeah. Could you imagine watching it on a screen versus what we experienced?
It was... Do you mind if I ask you a few questions? I know you're the interviewer, and Sure. This is your show. I had some questions I want to ask you. But to riff off that for a second, that was one of the best presentations I've seen in a long time. It was very engaging, very dynamic. He had a DJ on stage, and it was just people were moved by it, and the stories, and people felt something at it, and it just reminded me of why we have those conferences, why we deliver let's put it this way. His presentation was phenomenal. It wasn't anything brand new that nobody hasn't heard before. It was just presented.
Well, the DJ was different.
It was 100% presented in a different way with a different message by a different presenter that just really engaged an audience into a masterful story. And people were just moved by it. Like that one young fellow that was trying to ask that question at the end, and he just couldn't even get it out because he was so emotional and so verklempt from everything. It was just, that's what a good presentation from a stage has to do, is it has to move an audience, and that's what it did. And I loved the conference and just watching people and watching the presenters. And I told you on one of the breaks, you were like don't take this the wrong way, but you were the most improved that I'd seen. But the good news is that's not easy, and for you would be the first to say is it's very difficult and very fearful for you. And I give you props for doing something extremely fearful and just leaning in and doing it anyways. To me, that I find that more inspiring than somebody who's been doing it for 20 years and is a polished professional, been doing it 1,000 times. But that one person that's scared in their boots and is fearful of doing it and does it anyways, is to me is more powerful than the professional that gets paid for it to fly around the world to go do something, right? So you put on a hell of an event, you guys did. You and Cherry both.
Thank you.
Yeah. How you feeling?
Tired.
Yeah.
It's now Wednesday, so it's only a few days.
So have you had the post-event hangover?
Probably still in it right now.
Yeah, right in it right now.
But there's work to be done, so here I am. I was working yesterday too.
Yeah.
But yeah, we got Jesse because we knew he'd kill. Yeah. From our experience now, like Grant was a bigger draw.
Yep.
But I thought Jesse killed it.
Yeah.
Yeah, and that is the consistent feedback we got.
He just told a message that told him more of a message from the heart as opposed from the wallet. Right? If you think about it, like Grant, God bless Grant, love him. He's, let's go, money, 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 money. Right? Jesse was all about that, but it was also about, I love the way he did the pointing at the hand, and he was just grounding the audience to, the money you make versus the lifestyle you live. It's just brilliant. Like if you just watch a master of just the way he commanded the room. And I thought the DJ was a cool thing too.
Yeah, it was pretty good. Yeah. I was pretty happy with everything. Yeah.
So you took how long, when did you have the idea to bring this out again? So let's back it up. This is, I'm taking over Erwin's show here this is the Truth About Real Estate Investing featuring Russell Westcott, interviewing Erwin Zito today. So you did the event in 2019, which was the last time I was on an airplane, was to come out here 3 years ago. Yeah. And you guys had a commitment to do one in 2020, wasn't? Did you made a commitment right away at that time?
Not right away. It was like a few weeks after.
Yeah. So you were committed to do 2020, and then something happened.
Yeah, I don't know what happened. Nothing's really. We just got lazy.
Yeah. Was Jesse the person that you had planned at that time? Do you know, or do you don't know who you had?
We actually had offers on some other folks.
Okay.
And they didn't work. We had Jesse picked as well.
Yep.
Because we seen him speak. Cherry took his program. I loved his books.
Yep.
So pretty quickly we had Jesse signed.
Yep.
So thank God we signed him back then.
Yes.
Because his price tag went up a lot.
Has it gone up? Well, there you go. So you made kind of
Grant's price tag has multiplied.
Oh, really?
Yeah.
So then you pivoted and said, okay, we have to postpone this. And then were you going to just kind of wait? You were going to wait until 2021, or when did you finally commit that we're doing this in 2022?
I think at the beginning of this year is when we set the date for November.
And then what did you say from stage that you guys had bought?
We bought insurance.
Cancellation insurance?
Yeah, because who knows what's going to happen.
Yeah,
right?
Agreed.
And we're talking about mask mandates here now.
And then you essentially had to, the whole cycle of putting on an event of that size, marketing, everything. You had to probably park businesses for a while, and I think, was it you, or I heard something that you had said that maybe you had even sold some, or you pulled some money out of the stock market, out of some funds that you had to earmark it over to this event, because it's all front loaded. These events are typically, you pay up front for a lot of this, and you don't get any of the revenue coming in until some tickets start coming in, and it's more of the last minute. And then even if you have an offer or two or things like that, it usually doesn't come in until post event. Yeah. because so you don't know what the results are going to be for probably another 6 months.
Accurate. So anyone who's looking to do an event,
Yeah.
like understand that is the truth about running an event.
Yeah.
Like Chair and I didn't get paid.
Yeah.
Like we're just working for free to put on the event. We have all these staff that we have to allocate towards running the conference, which is like a business.
Yeah.
Right. So it's very expensive.
It is very expensive to run an event.
And then for someone to flyer the cars in the parking lot afterwards and not speak to us and not contribute anything towards the conference. And also what they're flyering was competing directly with the sponsors that were inside the room.
Yeah.
Right. That's bad taste.
Yeah.
Right. They didn't put any money up. Right.
So
My sponsors did.
I agree. It's you learn a lot, don't you?
You learn a lot about people in general whenever you're doing business.
So now we're 48 hours post event kind of thing. After every event, how are you feeling about it?
Like always, could have done better. It's tough. It's a tough hand that we've been dealt, though. We're in the middle of a recession now. Maybe not technically, but I feel it. I see it. I see it with our real estate clients, for example. Anyone can look at the markets, stock, crypto, whatever. Everything's down. Yep. Right. So people are definitely not comfortable with where things are. Yeah.
And then there was a little crypto announcement or something this past week of something too.
Yeah.
I don't follow this. I just sit there and I go, anybody who's in that space, I go, please try to explain it to me. Now remember, I'm just a simple farm boy from Saskatchewan. And it's just crazy, some of that stuff.
It's absolutely insane. This is like our Enron. This is the Enron of our generation.
Yeah.
Right. But it's just ridiculous. Well, thankfully, a lot of Canadians were insulated, though, because it was only available to Americans.
Okay, good.
To be on that exchange.
But wasn't there something about the Ontario teachers' pension that had something in there?
They're going to have some explaining to do, like how they chose that as an investment.
Right.
And that's actually a good lesson for anybody. I think I'm seeing it myself, like that, like what we're talking about here with the Ontario teachers making, like, they put up, like, I think they lost like 90 million. That's what I'm seeing right now. Yeah. But how did you choose that investment? But I'm seeing the same among small investors who are losing money, going bankrupt. And like I look at the deals that they do. I dig into them. Like I reviewed 2 that were specifically in Hamilton of a company that went bankrupt. And like, I would never have touched these deals.
Yeah. Even during the biggest run up at the same time. It's just... So I found it quite funny now. Now it makes sense why Tom Brady has gone back to work, I guess.
I don't know if you saw a recent interview. He mentioned he wants to play in the CFL.
Oh.
When he's retired from the NFL.
Yeah.
Like one day he won't be good enough for the NFL. Yeah. But what's next, right? Yeah. If you need to work, what's next for a football player? Actually, no, he could have lots of careers. He can work in sportscasting, whatever, maybe coaching. But he mentioned he'd like to play in the CFL.
Well, what is he? Like 42, 43, or isn't he even older or something? Like he's still performing at an incredible...
I know, but if...
You can't go forever.
You want to be hit by a linebacker in the CFL? Yeah. I know it's not an NFL linebacker, but I'm pretty sure they hit pretty hard in Canada too.
Well, it was interesting on one of your presenters, Derek Foster. I really had a really good conversation with Derek. I met him. He's a good dude. Like he's just he's Canadian. Yeah. He's just a salt of the earth kind of a Canadian kind of guy.
Overly humble.
It was crazy. Like, he comes out in a plaid shirt and khakis, and it's just like...
He just needs a raccoon hat.
He does. He just needs Tim Hortons here. So we had a wonderful conversation, and we were just saying, we're kind of in the world of, let's call it the advice world in some respect. Content creator, investment, whether it's real estate or stock or, things like that. And he said, what other, if we were professional sports players, he goes, our careers would have been probably done. Your shelf life is until you're 28, maybe 30, maybe 32, maybe mid 30s. He goes, what other profession than investing do you have more value the older you get? Mm-hmm.
Like Warren Buffett.
He said the analogy he used was that Warren Buffett's 92, and he's probably a better investor now than he was when he was in his 50s. And the more experience you have, you can just draw upon that experience when you're doing your investment, or also draw upon that experience when you're giving your advice to people that you're coaching or sharing or creating content for. And I just find, as I get older in this business, I just see more patterns repeating and coming around. And that pattern that you told me about deals on paper looked terrible. Yeah. I've seen that. I saw all those kind of things happen in 2006, 2007, 2008 on the prairies. I saw those kind of things, and at the time, I'm not pointing any fingers at anybody that they did a bad job. I did the same thing. One of the biggest mistakes I made in my investing was during a peak of a market, and now I can only use hindsight to tell me it was a peak, but the signs were there. No different than the signs were coming here in Ontario. It needed a correction. The signs were there that I doubled down. As a matter of fact, I probably bought another 40 or 60 places at a peak of a marketplace in Alberta. As opposed to what I should have been doing is I should have been pulling the chips off the table in Alberta and moving that money into British Columbia again and in Ontario again, as opposed to doubling down at a peak. So then fast forward to what I started seeing happening in 2020, 2021. In 2021, February 2020, I actually have the post that I have, and I've now released it to the public, but to my inner circle coaching clients and my inner circle members, I put a post out and I said, guys, I'm starting to get a little nervous, and I'm getting my spidey senses are tingling about Ontario and British Columbia. The prices are starting to go faster than the fundamentals. It's outstripping the fundamentals. I put it on everybody on awareness. Be aware. And then as it continued going, and it got even worse. Especially with my personal coaching clients, I advise them very strongly. Now they do what I can only lead them to my insight and to what I believe is happening. They have to take their own actions. I don't ever mandate to anybody, because I always want, part of my style is you need to come up with your own decision. You need to kind of take accountability and ownership to your own decision. And once you decide, I'll support you on your decision. And I will tell you if I think you're going down the wrong path, but you still have to make your own decisions. I'll never tell somebody that you need to do this. It's something they have to do on their own. But I strongly encourage a lot of my coaching clients, British Columbia, Ontario, start selling your dog properties. Take the 80-20 rule, the 20% of your properties that causes the 80% of most of your problems, divest, sell it, get into cash, and take a look at Alberta again. And many of my clients did that. And, some of them kept a few. Some of them still doubled down and bought a few more flips and things like that. But I started warning people in February 2021 to start pulling out of a few frothy markets to go into the next up-and-coming market. And the only reason I could tell people to do that, because I lived through it by doing the opposite and making the mistake in 2006, 7, and 8. And that's just experience and being in the game long enough and being able to survive long enough to be able to pass that information on to the next investors. Like, there's a lot of people, we just chatted about this before. Lots of people out there right now that have only been in one market, straight up and 0% interest. And it caused, like, don't get me wrong, I'm extremely happy that a lot of people made a lot of money in a very short period of time. But now they're starting to see the other side of it a little bit too, and some people are getting worried, and some people got over-leveraged, and there's the old saying out there is, what is it? I may get it wrong, but timing the market versus time in the market. I 100% agree, and also sometimes memes are like bikini bathing suits, right? What they reveal is exciting, but what they cover up is vital. And here's what I mean. It's an old economics joke, but here's what I mean. If you ask somebody if timing the market is important, if somebody bought a place in February of 2022 in Eastern Canada, and they're now sitting here at late 2022 out here in Eastern Canada, do you think that the time that they bought the property was of interest to them? Absolutely. So I believe those two things don't need to be mutually exclusive. 100% time in the market, play the long game, be in it for a long term. But if you bought that asset today, the same place that you bought in February of 2022 and you bought it in November of 2022, you arguably could have got it a couple $100,000 cheaper now.
Yeah. And
that's a big difference in that short period of time. And if it made sense at that time, at that price, it would make even more sense now. So timing does matter. Now, you'll never get it perfect, and it's a fool's game, but it certainly does make a difference if buying during a peak versus a bottom of the market.
Yeah, we're buying for like 30% off what it was in February now.
Yeah. And I had some conversations with people, and they're going, well, is it going to keep going down? I said, I don't know. Maybe.
Yeah,
and,
not
and
much more.
And we'll get into it, and we can talk more about that. But then here's the conversation I said with them. I said the following is, what do you believe it's going to do? And they go, well, I don't know. That's why I'm asking you. I go, really? What do you think it's going to do? And some people come back and say, well, it's probably going to drop another 20 or 30%. And I said, okay. So here's what I would suggest you do. Factor that in to an offer you're going to make on your place, and let the seller tell you if the market's going to come down or not. Most times they'll probably tell you to pound sand. They probably won't sell it for that. Most times you might get one, but at the end of the day is if you believe it's going down, factor that into your purchase prices. But don't be surprised if you don't buy a lot too, because what we're seeing, now we're talking mainly Ontario here, is and you know the numbers better than I do, but I pay attention, is we're seeing an awful lot of people sit there, they listed their place, not going to get it, contracts have expired, they just pull it off the market. Well, we just won't sell it. We'll just hang on. We'll wait for a new thing. And listings are at an all-time low right now. They're as low as they were like in 2008 or something ridiculous too.
Because if you're not motivated, why would you sell in this market?
So people are sitting there going, well, I'm going to buy all these cheap properties. There's not really anything on the market to sell.
And what we are seeing on the market, it's estate sale or a renovation gone bad.
Yep.
And then typically estate sales, it's just tired property. Yep. So someone's got to come ready to do significant renovations. So
that's one of the things that I'm looking for in this market. So I have cautious optimism for this market. So the way I describe it to people, if they ask me, if you guys are asking me, is I look at it in three phases. There's a short term, medium term, and long term. So short term right now, it's not pretty. It is ugly. Cash flow is evaporated. Interest rates have gone up to try to fix it. It is there's a lot of fear because a lot of people haven't seen this, and a lot of people are saying they're going, I have no idea. Certainty is a very powerful human motivator, and nobody is really certain about what's going on right now. Right. So when people are not certain or they're not feeling comfortable, what do? Nothing. And when you have a lot of people doing nothing, we're seeing exactly what's happening in the marketplace right now.
Right.
Realtors' businesses are getting pulverized.
Oh, yeah.
Mortgage brokers are not getting any business coming through.
Because volumes are way off.
Exactly. So short term, I'm concerned. I'm very concerned. Batten down the hatches. Do what you got to do to get through this. If you have some alligators, either get really clear on what's a cost versus an investment, and get really clear on those numbers. Right. And if you have to get rid of a property,
or Disney Plus,
get rid of it.
Yeah.
Right. Yes. Thank you, Christy.
Freeland. Yeah.
I'd much rather they defund CBC and save us billions of dollars and let the CBC try to make it on their own as its own viable business, as opposed to having every Canadian cancel their Disney Plus. But as you could probably tell, my leanings towards my political views.
They'd turn into another clickbait outlet. So it'd just be vomit.
Yeah. So short-term concern, and got to do what you got to do. However, some people are just chomping at the bit right now. I had a couple conversations with people who are just rubbing their hands right now on things. They're out there aggressively writing aggressive offers to trying to pick up some property. Some people that had left the market in Ontario are now starting to come back and take a look. But they're the ones that started implementing a strategy about 18 months ago, and they probably got into cash quite a while ago. Right now, what I'm helping out a lot of my clients out in this marketplace is we sit there and we'll analyze the property, and we'll take a look at it as, okay, line by line, property by property. You have a place. Does this property have like a big piece of land attached to it that you maybe down the road, when all the new density laws come in, that you can put a garden suite, add 2 or 3 more units? Okay, there's some huge upside value to it. Is it at market now, or is it below market? If it's below market and you can't raise the rents, like one client came to mind was they're $600 under rented on their place. It's on a property.
Sounds like all my places. Yeah.
Yes. And they can't get the rent up. Go figure 2% per year doesn't make up to $600. So is it 2% this year, or what was it out here?
Yeah, something like that.
I think 2.5 out in BC.
It was low twos. Yeah. Here in Ontario.
But I don't understand. Wasn't it supposed to be for inflation? But isn't inflation running at like 7-8%?
It's supposed to be based on CPI, but it's nowhere close.
I guess it's not. I guess it's based upon votes. I guess. So, anyways, we come back and we took a look at the property. It was kind of like a town-homey kind of a co-op. They didn't have the land. They couldn't add anything more to it. They were under rented, and
it was already highest and best use.
It was already maximized.
Yeah,
and they did very well with it. To be honest, it over the last 4 years, it went up significantly in value, more than doubled.
Right. They bought in 2018. They did pretty well.
Yeah, they more than doubled. Right. So what?
Sorry, their investment or their property price?
It's an investment property.
Right. Oh, sorry. They doubled
the
their
purchase
investment.
Price. The purchase price doubled in that time.
They're doing okay.
Yes, they've done very well. Now, 6 months ago, they could have probably done a little better.
Yeah.
But so we decided at the time let's just play this like a game of chess, a game of cash flow. Is they've put it on the market to sell. They had to reprice it a couple times, and based upon what they're going to get for it, and they now have 2 offers, and I think they accepted one. They're closing very soon. They're going to take the cash from that. They're going to pay off their principal residence, free and clear. So let's say their mortgage payment was $2,000 a month. They now have an after-tax savings of $2,000 cash flow per month.
Yeah.
And the main thing I made sure to find out is if you're paying off that mortgage, let's make sure we do it tax efficiently and contact Cherry, and I think they did to just make sure they're doing it correctly, but make sure you have access to that money being readvanced in a line of credit. Then what they're doing is they're taking that line of credit, which they now have upwards of $400,000 to $600,000, to then go to another market that's at a bottom of a cycle that has a greater chance of cash flow. And that's what they're doing. And if they are really concerned that they need to have cash flow, I said, what, you guys have enough line of credit? You can come in all cash on your line of credit and just buy it outright. And then wait a year or two when interest rates potentially, hopefully, will come down again. We'll talk about that if you'd like to. And then you can refinance it at that time and put a mortgage in place and bring it back into the line of credit. So you just have an interest-only payment for the next year or two.
Right.
On that.
It helps your cash flow if it's just interest only.
Yeah.
Okay, which is what I'm doing on several mortgages.
Yeah. So it's just playing the game smartly, right? So that's example for most people. If you're sitting here and if you've owned a property in this marketplace for better part of 3-4 years, you're probably legitimately up $300,000-$400,000, depending on the property. Obviously, you've done very well. Now, it was better and it's gone down. If you do need to sell a place, you probably have done okay. Now, where it gets to be a challenge, and this is the challenge that I faced at the time, is so let's say you bought said property, it went up $400,000, and you just kept sucking every dollar of equity out there, refi till you die program, and you just kept buying more and more and more at the peak, and you took out all that equity, you sucked out all that equity, and you bought at a peak. Now there's some problems there. And how do I know that? I did that. That's what we were doing, is our Alberta marketplace in 2006, 7, and 8, the analogy I use, it went to Vegas and it went on a bender and it was growing 74% appreciations, and it was just going ridiculous amount of numbers. And what everybody was doing was just sucking every dollar of equity gain that was coming out of it, borrowing it all, and then putting it into another property at the peak. And all it did was the market was just to take a little bit of a turn. And there was an awful lot of people that, the game of musical chairs had stopped and there was no chair to sit down on. So
yeah, there's no more capital left to raise.
Yeah.
Yeah. It all dried up. Kind of feels like right now.
100%. Now, I'm not trying to put the fear of panic into anybody. And I have a feeling, as I was probably telling those mistakes that I made, I'm not making anybody wrong if that's what you did. Because I did it, and I coach people, and I told people, and I tell people to do that. But I've learned those lessons. That was 15 years ago.
Right.
So now I'm just a little more measured on the cavalier nature of using too much leverage at the same time. Like, I'll give you an example. current coach versus previous coach. Previous coach Russ was, let's just go for it, full on, full board. Let's, no matter what happens, we'll figure it out. The market will take care of you, right? Okay, so I'm working with this young fellow out of Calgary, and he's on his second transaction. His second deal is he wants to do a flip. And I said, I strongly encourage that. Let's do this. So he found a wholesaler. He's getting the property from the wholesaler. He analyzed the numbers. I analyzed them with him. He had the private lender, Calvert Home Mortgages, analyze the numbers. There's even a third-party outsider analyze. Numbers look good for a flip project. I said, okay, do me 2 more safety factors. If this property doesn't sell for what you can get, what's your bottom line, and let's say it goes into a loss situation, you can't sell it for what you would like to get, are you able to refinance it with a tier 1A lender, rent it out and hang on to it, and would it cash flow? So he did the analysis and he found out that his fiance would then be able to get a mortgage and they would be able to rent it out and it would cash flow. Okay, check. Even I said, let's do one more risk mitigation. Is if you couldn't refinance it, your girlfriend couldn't get a mortgage, would you or your girlfriend be willing to move into it? Put your current, they each had separate places, put one of your places up on the rental market, have that cash flow, and would you move into it and live in there? And they said, absolutely we would. So I said, now you have my blessing to go forward with this transaction.
Sorry, for those listening, Russell did the blessing, yes, the hand signal for blessing.
Yes. And the reason why I gave my blessing fully is because he has three plans in place.
Yeah.
And I'm a firm believer in the more you have mitigation and the more training you do, the less you will probably have to do it. What is the old saying? It's like, sweat more in training, bleed less in war. I guess that's maybe a butcher to an old Stoic philosophy saying. But the more you've done your homework and have all these exit strategies, the less you will probably need that. So lo and behold, he puts the house up for sale after a 4-week renovation. In the first 2 days, they had an open house, and I think they had an offer within a week. And tomorrow, the conditions should be removed, and he's getting $5,000 less than his outrageous price that he was forecasting to get.
Wow.
So he's able to, and that's in Calgary, just as an FYI. So you can still make good money in Calgary. Right. And what he did at the same time, when he was analyzing all the numbers, he looked at it and he's, he's financing it himself through his fiance, and he's paying her the lender fee. He did a lot of his own general contracting because he's a project manager. Like I use the term, I hope we can swear on your show here. You remember the movie The Martian? When there was that old saying, Matt Damon is, yeah. I'm gonna have to science the shit out of this. That's what he did. Is he's like the best Gantt charter I've ever seen. Like he's a project manager by trade. That's what he does. And he just literally had this thing line by line, who's doing what's doing. So he GC'd his own project, and he saved a lot of money there and just subbed everything else.
Experience in construction?
Nope. He has experience in some building project management, but he's never ever done any construction.
Okay.
And then he did a few things himself, just to do part of it. And he's going to do it very well. I bet after it's all said and done, he'll net out in anywhere between 20 and 30 grand.
Fantastic.
Yeah. In a 4-week plus 10 weeks. Right. So the point I was trying to get to was current older coach Russell made sure that we had a lot of risk mitigation in place before really pulling the trigger. Coach 15 years ago would have just said, hell bent on election, let's just do it and figure it out. And, and sometimes it'll work out, but at the same time, it can be a lot less painful.
Yeah.
Right.
Because for example, I actually have a DM, one gentleman who paid $12,000 for coaching. He lost 200 grand between 3 flips because he did not. I asked what happened. He said, I didn't properly plan my exits. And I'm like, didn't you review that with your coach? No.
Well, on two hands, it always takes two to dance. So, I'm not ever blame anybody, but at the same time, if you are paying for a service and you're not getting the service, you have to be very adamant to make sure you're getting what you paid for.
Right.
And on one hand.
Right.
But on the same time, as a coach, it's a little black eye in the coaching industry if you're not
Oh.
able to give advice to. That's your job as a coach, is to be that sounding board for the enthusiasm. Because a lot of this people, let's put it this way, when somebody enters into a coaching relationship as they're being coached, they're a high performer already, right? They usually don't need motivation. They're already motivated. What they just need is they need the guidance, and they need to be pointed in the right direction, and they need to know if they're going to be stepping on a landmine in advance. And that's really what the coach needs to do, is they need to really help them not step on those landmines. I'll give you an example. Someone we both know very well, Mr. Joe Costanza, been on your podcast many times. He and I have worked together for a couple years now. And I've been a sounding board for him many, many times. And some of the times he comes, he goes, Russ, he goes, I'm a little nervous. Okay, well, let's talk me through it. Walk me through it. He's having a conversation. How do I handle the conversation with mom and dad? It's going down. And I was just out at his project out in Hamilton, which you're very well aware of. Tammy, I think, helped instrument that too. And we just walked through the numbers, and it's a rock solid deal. Even though a year ago the cash flow would have been $1,000 and now it'll be $400 or $600.
Oh, poor
right?
What was Joe?
But exactly, but still, isn't that much better than starting at 400? Now it's negative, right? Mm-hmm. So it's just having that sounding board of somebody who's been in the trenches and that's there with you. And one of the hardest jobs I have as a coach is to take somebody who's operating at a high level already and even get more out of them. Like that's difficult to do. And you know what it's like. You have lots of coaches in many respects. And Marianne, she's still a coach? To get you, who operate at a high performing level already, to get even more out of you is a lot of it's hard work, right?
Part of it's just trying to work smarter versus harder.
This is true,
right?
Yeah.
Like I'm going to work hard no matter what. Might as well. Where should we work hard?
Correct.
Right. So that's what again, that's what we're trying to do for next year.
Yeah. And what happened over the last 3 years is what I would call the rise of the people that did stuff turned coaching. Many of the coaches that are probably out there, don't get me wrong, have probably taken lots of action, and they've taken lots of, and they bought lots of properties, and maybe their intention was a little differently, because I've talked to a few of them. Their intentions were to take lots of action, put a group of people together, become their coach, and then sell properties to that group. Mm-hmm. Like that coaching that model is as old as time itself, right? I've done it myself from time to time. I've stopped doing that probably within.
Sorry, just pause you there, Russell.
Yeah.
That to me, that has to be the model. Sorry, not has to be. I actually was someone I know who was a cousin of a good friend of mine was raising capital directly to their phone on Instagram. Right, so the Instagram live or whatever recorded video. I'm looking to raise capital for this project I got going. I DM'd him and said, "Dude, please run that by your lawyer."
Yeah.
Right. He's directly raising capital from Instagram. Yeah. Social media publicly. Right. Please run that through your lawyer. He goes, "What did I do wrong?" And he goes, "Well, ask your lawyer." And then he says, "What should I do different?" I said, "Offer coaching instead."
Yeah, absolutely.
I said that's what everyone else is doing. They offer coaching, which is not a security. Yeah. So you're not violating securities commission, violating securities law, and then you sell them. Then you sell them on raising capital. Yeah. He goes, "Oh, that's why everyone's selling coaching." I'm like, "Yes, exactly."
Yeah. So I believe that intention has gotten a little off. Like, if you're going to be a coach and be there for that person, don't coach somebody to have a group of people to sell them properties of your investments.
But that's the reality of things right now.
Yeah,
lots of them. Not all of them, but a lot of them.
Yeah, a coach is in service for the client to help get the best out of them, not to sell them more stuff. That's my personal philosophy. As a matter of fact, I've actually taken the opposite approach, and here's the opposite I've taken with it is if I've done a good job of coaching. And how I measure if I've done a good job of coaching is their accomplishments will far outweigh anything I've ever done. And as a matter of fact, they're probably a better real estate investor than I am. And I want to, and one of the things I'm weak at is the operations of a business. I'm not good at it. I'm a good ideas, vision, promotion, inspiration,
Raising
communication,
capital.
raising capital. I'm good at that.
Yeah.
I'm not that great on. I don't have a cherry.
Right.
That's the operator of the business.
Right.
And
there's a big difference between like Tim Cook and Steve Jobs.
Correct.
Right.
Yep.
And in my opinion, Apple would not be as successful as it is without Steve Wozniak, for example. You need someone that can execute.
Yes.
Right. You need someone who can sell as well.
Yep.
Right. So it's two jobs.
Everybody's got their role on the team, right? And so I've identified that, and then so what I'm then identify with the people that I'm coaching, and if I've done a really good job of coaching them and they're fantastic business, I want to identify the amazing business operators. I want to identify the amazing people that have these wonderful projects, probably better than my projects in some cases. And then what I'm going to do is I'm going to bring capital and invest in their project. Like case in point, I'm going down into the States, just dipping my toe into the Texas market a little bit. So I've aligned with somebody who I coached long time ago, trained him, not one-on-one, but through when the Days in Rain. And I just saw what he's done. He's just doing phenomenal. He's got a brilliant business model, and he's just doing phenomenal. He sold a good portion of his portfolio out of British Columbia. He's moved his family down into Texas, and he walked me through
Austin.
Austin.
It's just funny. Yeah. If it's a Canadian Texas, it's usually Austin.
Well, I call it. Well, maybe the Americans would call it. I call it the Alberta of the U.S. But the Americans would probably call Alberta as Texas of Canada. I guess. Yeah, but I call it. It's almost identical. Like, honest to goodness, with what's going on, same thing. Low taxes, no land transfer taxes, money flowing in, people making good money. People, lots of infrastructure being spent, corporations actually hiring people, lots of stuff. So what I've done is I've identified those projects, and what I'm doing is I'm bringing capital to invest into those projects. So I'm, as the coach, investing into their projects, right? So I think that's the way it should be, as opposed to the other way around. And don't get me wrong, like I said, I haven't had a coaching client. I haven't offered one of my projects to a coaching client for probably about 4 or 5 years at least. But I did before that. And it was a model, and I probably taught the model, to be honest. And probably people would just learn that type thing. And it is a very good model, but it always does come down to the intention of that. If your intention is to just make sure you put good people together with good projects and do whatever it takes to make sure it works out, it doesn't always. That's unfortunately. Sometimes things go sideways.
Yeah, and we're seeing that now with the market can't save a lot of these projects that are being sold by coaches. And that's the reality of things, That's what market corrections do. They'll flush out the weak properties, the weak deals, the weak hands. So that's capitalism. Right. So unfortunate. So awesome. I'd love to hear more about the Austin deal. But something we were talking about before we started recording was two things. Well, before we forget, I want to get to the Saskatoon rent-to-owns for small businesses. We'll get there. But before that, I asked you for an update on what you're doing in Edmonton, because last time you were here, you talked about you were doing duplexes before, but then you had since pivoted to townhouses, and now you've actually improved upon the model even further.
Well, so the model is still the same with its new construction. And we can get into it. There's a long reason why, and the reason why I came to that conclusion is I bought older deferred maintenance properties in bad areas with bad tenants.
Condo fees as well.
And I took that in the shorts for many, many years. Once I pivoted over to a brand new construction model, it was like a breath of fresh air. You get a completely different tenant profile, your maintenance bills, you get no phone calls, rents come in, they cash flow very nicely, the set it and forget it model.
Warranties, stuff is warranty.
New home warranty. If you get a phone call and it's still under warranty, if the furnace went out, it's under warranty. It costs you maybe $250 for the service call because you can't write it off. But if there's something that was wrong with it, they fix it for free. Just all kinds of things like that. So what we've pivoted from a little bit is because here's what's happening in Edmonton is Edmonton is now densifying a lot more. It's taking older houses, and you potentially can knock down an old house on a large lot and build 3 side-by-side townhomes with suites. So where there was 1, there's now 6.
Right.
And so you're seeing lots of those kind of things. And I'll give you an example.
Sweet.
Yeah, I'll give you with some numbers. Now, I might not get all the numbers correct. This is just one of my clients, and we just shot a video out on site on doing this. So he bought a house in Edmonton, inner city, like right off of the GO train is going to be like, within 1,000 meters, within a kilometer, or not the GO train. That's out here. There's the Edmonton transportation, new stations coming in. Bought a house for 3 and change, okay, for a house with a large lot.
Like how large? Like 175 foot wide?
Yeah, okay, enough to put 3 townhomes on it, right? With the detached garages in the back. So,
wow.
So big. So knocking down the house, and he's building 3 townhomes, side by each, with suites, detached garages in the back, and actually has approvals to put garden suites above the garages if he wanted to. He literally could have 9 units where there was once 1 house. Chose not to put the garage suites up yet because there was not enough. He felt there was not enough parking. Sometimes if you can do something, doesn't mean you should.
Yeah.
There would be just too many people in that footprint. But he can do it, and he can potentially do it down the road. So build cost on that's about 1.2 million and change. He'll be into it for, let's call it 155. It's appraised for 1.7 and change as a fully finished done. Then he's going to, during that process, he's going to do the MLI Select program, finance up to 95% loan to value, 50-year amortizations. So into it for 1.5 for 6 units, brand new. And those will rent 33 per stack. So what are we talking? Just shy of 10 grand a month.
That's awesome.
And that's at today's rental numbers.
Right.
In a year when the construction is done, I guarantee that will be close to probably 11 to 12 grand. The way the rents are going right now. So let's call it, for conservative, let's say getting 10 grand per month in rental on a $1.5 million build. The value's at 175, and if he gets that 95% loan to value, 50-year amortization, the cash flow is going to be great, and he could pull out every dollar plus.
Yeah, it's a fantastic deal.
Yeah. So those are the kind of things that do that. And so with my best business relationship in Edmonton, and I call him my partner because he's my partner in crime,
business partner. Yeah.
Jason.
Yeah.
He finds those places, all those kind of deals all over the place.
Love it.
And
I love a repeatable business.
That, or I'll give you another example. Client out of Saskatchewan, busy veterinarian. We found him a 8-unit townhome project, 4 in the front, 4 in the back, for $300,000 each. So 3.2 million. For a brand new townhome. He owns the entire project. He doesn't have to put condo fees into it, right? At $300 each. They rent for about $2,200 each. 2,200 times 8. What is that? 16, let's call it 17, 18 grand.
Yeah, close to 18, yeah.
Right?
Yeah.
So he now controls the whole 8 units. And then over time, the advice I gave him when I was talking to him originally is, if I were you, what I would do is I'd hang on to that and just rent it out for 7 years. And then from year 7 to 10, I would start the process of selling them off individually, one at a time, and be out of it by year 10.
Before
maintenance has to start kicking in, and before you have to then start doing, you'd have to probably set up a strata after you sold 50% of them. Once you don't have 50% ownership of something, you have to set up a strata.
Yeah, that's what you pay for coaching,
right? So the advice. So he's closed on it. He's owning it. It's gotten rented. Fantastic tenant profile. It's all 100% managed. He's still operating his vet practice, and he's just going to wait for 7 to 10 years, and then he's going to sell them off. Buy by the yard, sell by the foot.
Yeah.
And with that one transaction,
buy wholesale, sell retail. Yeah.
And that one transaction, just that one deal, So at 3.2 million, what is that? They're into it for 400,000, give or take. No, it'd be more. What is that? So what's 20% of 3 million? Would be 600.
Yeah.
600 grand. They're into it for 600. So with that one transaction, gone through right to the end, that could be their family's pension plan, which is one deal.
Yeah, fantastic.
Right?
Yeah.
And he potentially doesn't have to buy any more if he doesn't want to.
Yeah.
And he's just going to pay it down and then sell it off in a marketplace that, in my opinion, is just starting its next growth cycle.
And we're talking about
Edmonton, yeah. And so there's lots of just different opportunities like that. And then, talking with Jason, one of the things we're always trying to just remove barriers for people. Right, remove barriers for people to get into properties. One of the biggest barrier right now is, I'm always honest with people, and I tell, look, a year ago, these places that would show you would be anywhere between say $400 to $600 cash flow on a pro forma. Now they're like 100 to negative 200, and especially then if you're financing your down payment, they're negative. They're negative cash flow. Right.
If you're using your HELOC for down payment.
If you're using your HELOC for down payment, yes. So I'm just honest about that. So Jason and I are sitting there, well, how do we solve problems? So one of the problems that we're looking to solve, and it's still early in the phase, like we're just testing it out right now. We've got all the approvals, and he's got his brokerage on board with doing this and how to do it the proper way, like with everything 100% documented. Is we're looking to bill property management fees for 2 years into the purchase contract. So essentially you prepay your property management for 2 years. At closing, that money would be distributed to the property manager. You get a little bit of a discount because you're prepaying, but you now have no property management for 2 years. So that's one thing. The second thing we're looking to do is to potentially go to the builders and say, look, if they have inventory, if they want to sell something, if they're motivated, instead of maybe giving a giant discount of $20,000 off the price, would you pay property taxes for the next 2 years? And they would do it as a holdback, where they put in the account property taxes for the place for 2 years in the lawyer's trust account, which would be distributed. So if you had no property management and no property taxes for 2 years in that property is now cash flowing for the next 2 years during this high interest rate environment. In 2 years, the interest rates are going to hopefully drop, which I think they will, but they might not. But let's bank on they will. Every forecast I'm seeing in 18 months to 2 years, they'll probably be lower. But also you have 2 years for rents to get up, right? And the way I've seen rents are going in Edmonton right now, rents are, in my personal opinion, are significantly under rented, even though they've gone up. And here's the example I would use. Out here in Hamilton, you guys call them duplexes. We call them houses with suites. I was just out there. So in Hamilton, for a house with a suite, nicely appointed. It's, it's not brand new. It's, the typical 1950s. It's been renovated. You're getting anywhere between $38,000 to $4,000 for those kind of places now, right?
A bit more for it's renovated recently. But
yes. Yeah. So let's call it anywhere 38 to 42 for the whole house. Between the lower suite and the upper suite. In Edmonton, my brand new properties are now just pushing 32, 3,300. So in my personal opinion, and
so it's your house with a suite?
House with a suite.
Okay.
Between the upper and the lower.
That's brand new.
Yes, brand new.
Yeah.
Are getting like 32 and change. Okay. Now I'm going to probably either defend Edmonton or Hamilton, but I look at those two markets very similar. Edmonton and Hamilton and nobody can convince me that Hamilton should be an $800 premium to Edmonton in rents. I can't see it. I just don't see it. Right. The one thing I do see is that there's rent controls, and every rent control market is always higher priced in rents. It without question, you will see that. So I believe that Edmonton's just starting its rental increase run too. So if you buy in now, you have 2 years of property management paid, and you have 2 years of property taxes prepaid. In 2 years, your rents are up. You then take over the property management plus the property taxes, plus with a lower interest rate and a higher rent, you're now cash flowing again, and it's been maintained during this transition time.
Right.
And you got all the mortgage pay down, you got all the appreciation. Now,
just pause you there, Russell.
Yeah.
This is the first I've heard this. I love it.
Yeah.
I love the creativity. I love, and you're already getting this done as long as the property appraises. Banks see everything.
That's the biggest thing. Is
black and
just
white.
to make sure that the property has to appraise.
Right.
But what we're just doing, and here's just some of the numbers we do. If you're buying a new property, many times the builder will give you, until recently, the builders were offering like discounts. Like they would offer, 10, 20, 30, depends on how motivated they were to sell. Those discounts went away just recently because the market was hot.
Right.
The market's
the
slowed.
population is growing in Alberta, is it not?
And absolutely.
Yeah.
We just had the last quarter, they added 42,000 people of interprovincial migrants. That wasn't out of country or births. That was just interprovincial.
Right.
So I was driving in from Sudbury today, and I drove through Innisfail, which is 37,000 on the sign. That would be like adding Innisfail. Innisfil.
Yeah, Innisfil.
Innisfil. That would be like adding Innisfil to Alberta in the last quarter.
Yeah,
and that's been 4 quarters in a row.
Yeah.
Right. So
it's probably the trend is likely going to stay that busy, is it not?
It hasn't been slowing down, right? And Edmonton. I'll say Edmonton has slowed. The sales have slowed a little bit, but holy moly,
could just be
Calgary. Calgary's been like the darling of the country. Calgary is up 9% year over year. Sales are up. Everything's up. And I always use.
And they've had a really tough go.
Yes,
as well.
I always use Calgary as what's going to happen into Edmonton 6 to 12 months from now. So I'm seeing all this growth. I'm seeing this happen. They just announced a couple days ago of a $500 million world's largest hydrogen plant that's going in just outside of Edmonton. And that's coming. And the other thing is, and it's funny, I thought everybody always knows everything about Alberta, but they just had a $14 billion budget surplus on their budget. Surplus, $14 billion. So what the provincial government did is they
send transfer payments to Ontario?
Yeah. That's after transfer payments to Ontario. It still had 4. So what they've done is they've re-indexed all the income tax levels in Alberta. So what does that mean? It's fancy talk, meaning that people in Alberta will have more cash in their pocket. Yeah. They'll pay less in provincial sales and provincial income tax. Couple that with no PST. They're paying less than $1.40 a liter for gas. They're buying housing for half the price.
Half?
In many respects.
What's the average price of the house in Calgary?
In Calgary, it's a little bit more, but in Edmonton,
600,000. What is it? What's average in?
And Calgary, you're probably 560, 600,000 Calgary. Yeah,
that's fantastic.
Yes, and I'll give you an example. It's real life. I have a property right now I'm selling. One of my joint venture partners is wanting out. He turned 82. He just said, "Russ, enough's enough. I'm out. I don't want to do anymore." I said, "No problem." So we put up our half. We have a half duplex. The side by side common wall between nice properties.
Yeah, we call them semis. Yeah,
you call them semis.
Yeah.
It's 20 years old. It needs some paint. It's got the old, go figure, mushroom basket brown in there because we haven't painted it for a while.
Oh my god, I haven't heard that in years.
Old floor. It needs paint and flooring, right? It's not, but it's actually a really nice property. It's $209,000, $210,000 for a semi, for sale.
Damn.
Right? And my partner's going, "Well, geez, will we get somebody?" I go, "Well, let's call him Joe." And I said, "Joe," I go, it's $210,000. Like, it's like, we're not asking, something like that where I live in Vancouver and area. Minimum is 800,000 minimum. So you could buy 4 of them for the same price, right? And a good friend of mine, and there's so many people that are just, 2 quick stories. Edmonton is being known as, I think they call it a Zoom town a little bit because you can actually do your work on Zoom nowadays. So you just go out, and one of my clients goes out there and they've bought a property with a garage suite. They lived in the garage suite. They work in tech. They can work anywhere in the world because most of their contracts are with large companies and they just do their work out there. They bought the garage suite. They live in the garage suite. They rent the house. They do that for a year. They do it then they move into another one. They've done it twice, and they're going to do it 3 times over a course of 3 to 4 years, where they will just move into the next property. And they'll get, residential financing. Everything's 100% above board. They move into it. They live in it as a resident. They fully declare it. And by the time they're done in Edmonton in 4 years, they'll have a six rental unit portfolio that they just moved in 3 houses.
Fantastic.
So one or another one, mortgage broker. He was looking around and he was sitting there going, he goes, what can I buy around this area? I can do my mortgage brokering business anywhere. He moved out just outside of Edmonton as a 5-acre lot for less money than he would have been paying for one house in a subdivision with no land, no lot, no nothing. And he lives on this beautiful acreage, right? So there's that kind of stuff that's happening all day long.
Mm-hmm. What's driving the cycle in Alberta?
Right now, main thing is energy. It's commodities.
Mm-hmm.
Very bullish on commodities. And I'm very careful to say energy because that's what it is. It's not oil and gas, but by and large, that's the bulk of it, is oil and gas. However, Alberta is so quickly pivoting to renewables, to technology, to different things. Like I said, that hydrogen plant is going to be the world's largest hydrogen facility.
To power vehicles?
I believe that's what it is. I'm not fully up on that, but if you look it up, I think there's a lot of people very big on hydrogen right now versus natural gases and oils and stuff like that, I believe. Down south, Lethbridge area, I have some clients down there that are just crushing it with Airbnb executive rentals. Quick story. So they buy house was sweet. They did a long-term lease rental with an Airbnb. Then they did very well. The next one they bought, they tried the opposite. They Airbnb'd the upstairs and straight rented the basement. They were doing very well. The next one they bought after that, they did the whole thing on Airbnb. And then they go, geez, it's just doing so well. So meaning down there, lots of solar and wind is also going in at the same time. No, those things are still small, but they're growing. And not only do
I pray that they work, that they're efficient.
Yes.
They're worth the capital investment.
Well,
because it's not working so well for Europe.
For another debate.
Well, Europe's our experiment.
But
CVL can live without energy,
but here's
without
the
oil
thing
and gas.
that I tell people is, in order to create those technologies, you need energy.
Yeah.
And that's what Alberta has. They have a safe, reliable, affordable energy source to be able to develop new energy sources.
Right. That's exactly what Norway is doing.
Right. So it's going very well. I'm always optimistic with things, but I've seen the cycle and I've seen it being flat there for better part of over a decade now. And it's just starting to trend in the right direction. And I think the last time I was on your podcast, I think I shared my thesis about why Canada is should be a world superpower. It has the 7 things we need, right? We have food, fuel, fertilizer, forestry, fresh water, future tech, friendly family values, right? And here's the analogy I use, and I think I shared this on another podcast recently. And you're a hockey fan, are you? Sort of, right? Canada needs to just pick what we're good at. We're good at hockey. And we're good. We have resources and we have commodities. Let's not sugarcoat it. But that's what we have. We have to offer to the world. We have resources and we have commodities. Okay. So let's use a hockey versus economy analogy. So it would be like saying, okay, well, Canada, we want to be really good at basketball, but we're not good at it. We're not good at basketball, no, we're going to become a good basketball team. Or we can sit there and go, well, why don't we just be the best hockey team in the world? Let's get Canada together. Let's win. We want to win as a team, right? And so if I was the coach of Team Canada, what would I do? I would sit there and I look around my team in the dressing room, and I'd sit there and go, you know what? We got good stay-at-home defensemen. We got grinders in the corner. We got scorers. We got good wingers. We got backups for that in case people have. But we got a superstar. We got Connor McDavid on our team. Connor McDavid is the best.
You had to choose an Edmonton player.
He was actually, he played up in Sudbury too. I was just up there and they were telling me that. I go, do you guys know Connor? And they go, well, yeah, he played here. His girlfriend's from here, right? I go, well, then you definitely know. But you have the superstar. And I'm sitting there going, if I was the coach, I could coach this team one of two directions. I could coach this team and say, look, Connor, you're a superstar. I want you to play as hard as you can. I want you to be the best you can. I'm going to support you with everything around you for you to be the best. And I want you to elevate everybody's game around you up to the next level, to be world class. That's one way to coach the team. Or the other way to coach the team would be to go to Connor and say, Connor, you're playing a little too good lately. You're Austin Matthews, he's in a little slump right now. You're making him look bad. Could you just slow down a little bit right now? Don't score too many goals, Connor, right? So if we want to win as a team, why aren't we really playing to our strengths, and why aren't we supporting our superstars to shine? Because the more our superstars shine, it lifts everybody up. And then there's other players, like, why isn't Ontario, and they could very well be, why isn't Ontario developing world-class nuclear energy? They have lots of room. You have lots of the water to do all this kind of stuff. We have all the uranium in the prairies to do that. Why aren't they becoming a world-class, or even just if it's not that, and you don't like nuclear, why aren't they doing more hydro projects?
Hydroelectric? Yeah, I don't know why either.
I don't know. Pick what we're good at, and let's just do it. Let's satisfy our own needs. And it just, as a good capitalist Canadian, caring Canadian capitalist, it just breaks my heart when I see like countries like Germany coming over and say, Canada, can you please give us a little natural gas to put in our furnaces? Put in some furnaces, for the winter. And then we just sit there, no, but look, we have some windmills over here and some solar panels, by the way. We're not going to sell you any natural gas. Then you have to go to Russia to buy some resources to help heat your furnaces.
And now the Middle East.
Yeah, that too.
Those are very friendly people.
It hurts my feelings to know that just we have something for sale and we are embarrassed to sell it.
NIMBYs of a different type. Anyone who wants to look it up, go on Wikipedia, look at the Eastern Energy Pipeline.
Well, you want to know something interesting? Now, this is just pure, really early. Alberta, Saskatchewan, and Manitoba are getting together to talk about, and this is early negotiations, they're saying if there's not going to be a pipeline that's going to go all the way out to Eastern Canada, if there's going to be blockades in Quebec or whatever.
Ontario's guilty too, but yeah.
Both of them. Yeah. If they're going to put up roadblocks and not going to do it, between Alberta, Saskatchewan, and Manitoba, they're actually proposing putting pipeline to Churchill and piping it to Churchill and then sending it out through northern Manitoba.
Interesting.
Yeah. So there's lots of things that they'll find a way. In many ways, they're very entrepreneurial in that case.
Then the agreement has to be then that the East doesn't get any of that money. Then
maybe. Right? I don't know. I believe now this is way above my pay grade, to be brutally honest. But I think all that jurisdiction, a lot of that stuff falls federally anyways. So there's going to be some pretty big lawsuits and things that they have to do anyways. But here's the thing:
what a joke this whole thing is.
But let's think about this for a second. You guys just had some fairly serious negotiations about teacher salaries and things out here in Ontario, and there's been a lot of
healthcare,
everything. Yeah. If you want to pay your doctors more, and if you want to pay your teachers more, which we have to, let's let Connor McDavid score more goals, and let's get more. And I don't think as Canadians we would be upset if we as a country reap the benefits in one area and we paid and helped get better world-class healthcare, world-class education, affordable housing, and affordable food and affordable energy. I don't think anybody would complain about that in Canada. But you have to pay, that money has to come from somewhere. Yeah,
I don't think the average voter is educated enough. It's like oil's bad, let's not do it. Pay the teachers more, pay the nurses more.
Yeah, but who's the? I would be very interested to find out who the people that are the ones that are saying oil bad. If it's not maybe the lobbyists and people that for many, many years were paid an awful lot of money to make Canadian oil sands and Canadian energy to be the very bad thing out there. And if you really dive into it, it's some of the most environmentally sound, sensitive things. And I would stack up what Canada is doing for energy exploration and production against any jurisdiction in this world. And I would be very confident in saying that we're some of the most environmentally sensitive things out there. There's someone who I follow quite regularly, Eric Nuttall. And yeah.
He's legit.
100%.
I've seen his stuff on Twitter. I'm just cautious if he's legit or not.
He's good, and he's very clear, and he says that, he does a lot of ironic sarcasm posts every once in a while, and talking about how they were doing this energy exploration for this pipeline, and they had to move the moss because it had this certain type of frog on it, that they had to relocate all this moss and all the frogs that were in it to another area. And they spent all these millions of dollars just to relocate these horned toad type of frogs that were very just native to that area. And that's the kind of things that we do. Like, in many jurisdictions, they don't care. Like, honest to goodness, they just sit there and they just bulldoze everything down and away we go, right?
Well, Europe's going to burn wood and coal to heat their homes.
Yeah,
we're worried about frogs.
They send over old wood pellets and chips over there to burn it to heat, and then they call it environmentally sensitive.
Folks need to make a decision.
Yeah,
we're way off track.
Yes, that's what I love about these conversations. You're a very interesting guy, Erwin.
For example, there's an article yesterday in the Hamilton Spectator about there's people who are upset about the height restrictions being removed on 30-story, right? For the first time ever, I saw the term vertical sprawl. Yeah, you're about to spit. I know.
Yes, I have that problem all the time.
Vertical sprawl. And I think what people need to understand is we either sprawl somewhere within urban boundary, or we spread outside the urban boundary, which includes green space, right? Green belt, right? So you make a decision. Where do you grow, right? You want to grow up? You want to grow into these areas that are environmentally sensitive.
Yeah, I've been out here for the week, and I forgot. Like, it's been 3 years since I've been here. I always forget. Everybody always thinks this whole area is just wall to wall people. It's just big city everywhere. But there's everything is so spread out, and there's just lots of green space, and there's lots of things. I work with one of my clients down in the Niagara area. And some wonderful opportunities out in that area. We were out, might get the names wrong, Port Coburn and Crystal Beach. And fun little project. Mm-hmm. They took a commercial old grocery store that had been vacant since the 50s. And they're turning it into a fourplex.
Nice.
And once they're all done, everything's done over the phases, they'll be into it for about $1 million total. And it'll rent for, give or take, I think it was just about $7,500 to $8,000 a month.
Fantastic.
Yeah, so that's a good yield and stuff. And
converting existing space that's not being used into housing.
100%. And they were very, like, the city was like, really? You want to take that building? Cool. And I was joking. I called it, I said, his name's John. I said, John, you got to give this project a name. He goes, well, we just call it Davie Street. And I go, well, come on, you got to have a better name than that. And when he took me through, he showed me the old meat lockers and all this, because it was an old grocery store. And I said, this is the meat locker. Right? That's what you got to call this one. It's the meat locker.
Like, as the unit?
As the whole project, the meat locker. Sometimes you have to give projects a name because it's fun.
Internal name,
yes. You would put the big sign on the front. Welcome to the meat locker. Erwin, we can't have fun here, by the way.
Oh, no, it's just I'm a marketing guy, so I don't know how you market a rental called the meat locker.
I was just sitting here, Erwin, I failed to mention, and I had to mention here, there's like, we're sitting around with all this hardware in your office here, and these awards.
You gave some of them to me.
These are some very hallowed ground that we're on here, too. I'm very honored to be able to have a friend like you. I'm very honored for you to trust me enough with your 17 listeners to let me, just have a place to share what's going on. And I just wanted to thank you, right? And I've said this, I think I said this on Saturday, that if there was, more people like you and Cherry in this world, there'd be a lot fewer problems. Like, you guys are good people. That's an old saying from Saskatchewan, use good people. And you guys are about as good as it gets. So I just wanted to just thank you.
Thank you,
Yeah.
Russell. Thank
Yeah.
you, Russell. And thanks for coming on and sharing what real talk.
Yeah.
Real talk.
Yeah.
Because there's a lot of real talk that's missing out there.
Yeah. Well, it's, the only thing I can do is share the real talk.
Thank you, Russell.
Right on. Thanks, brother.
Thank you for watching. If you want to learn how to invest in real estate from scratch, my team teaches beginners how to use the #1 investment strategy that I personally use in a virtual free training class every month. Go to investortraining.ca/YouTube to register for our next class. The link is also in the description as well. I publish at least 2 to 3 videos a week here, so subscribe if you want to keep learning from seasoned investors like myself and my guests. And if you're just starting out, feel free to ask questions and comment below, and I do the best to answer each of those comments and questions myself. Again, if you're ready to learn the nitty-gritty about real estate investing from a professional investor, register for our next virtual class. That's at investortraining.ca/YouTube. Thanks again for watching. See you in the next video.